MACD, people call it differently, is one of the most popular indicators in trading. Millions of people use it every single day, plain and simple, but if you've already worked with this indicator, with the MACD, you probably know its main problem. It works great in a trending market, that's all fine, but as soon as the market starts moving sideways movement, accumulation, a range, or anything similar on the chart, the MACD starts to give false signals, and it gives them pretty harshly. At such times, it's simply useless, absolutely useless, because it shows false entry points and false exit points. You simply end up losing your money when the market is moving sideways. You eventually give back all the money you made using the MACD indicator while the market was trending. But what if I told you that there is a new version of the MACD and many other useful indicators? Essentially, it's an upgraded MACD that works much better, especially when combined with other indicators. Dynamic accumulation zones, dynamic zones that actually indicate the level of fear among traders, or on the contrary, the level of greed among traders and investors. I've been using these indicators for 8 years now, and not once have they let me down. Absolutely not once. They simply never make mistakes. So in this video, I'll show you what these indicators are, what settings I use, and at the end, I'll give you a trading strategy, a working trading strategy for using these indicators, which you can start applying literally right after watching the video, even today. You're on the Vice Flow channel. My name is Alexei. For a long time, I worked at various cryptocurrency exchanges, CFD brokers. I had a very full and interesting career. At the moment, we are developing trading indicators, perfect models that show unique market entry points from all angles, both on global charts like weekly or daily and on local charts, down to the 5-minute or even 1-minute time frame. Let's begin. So, I really do have something to share with you. Let's go. First, we need to understand how the MACD works in general from a technical perspective. It is a widely recognized and highly popular technical analysis indicator of technical analysis that shows the strength and direction of a trend, as well as potential reversal points by analyzing the relationship between exponential moving averages. As a rule, a 12-period moving average, a 26-period moving average, and in fact, a 9-period moving average are used. All of this is actually demonstrated on the MACD. We can see that all of this relates to the potential moving averages, and as a result, the oscillator produces certain types of moving averages, plus a specific histogram that helps to identify divergences and convergences at an early stage, essentially providing buy or sell signals. Identifying an early impulse is the most important concept in trading. There are approaches like line crossings. Specifically, when a line crosses here, you should, for example, enter a buy position. Zero line crossings are quite frequent signals. They're not particularly effective, but they do occur often. If you are a full-time day trader, the zero line can be interesting. Divergences and impulses are the most important. Divergence and impulses are also the third and fourth concepts that can be used with the MACD. Divergence is very straightforward. The price, let's say, is falling, but at the same time the histogram is rising. Go long. Similarly, when the price is rising but the histogram is falling and the moving averages are declining, you should go short. And overall, on the chart, all of this looks quite interesting, undoubtedly interesting. However, it's very important to note that impulses usually come to an end just when it's time to enter based on the indicator's signals. These are all late entries. Market makers and hedge funds do not enter based on indicators that were used 100 years ago to determine prices for gold, oil, or precious metals, back when exchanges barely even existed. This is a basic, standard indicator that for some reason people try to interpret for the present time, even though market makers now use much more cunning and sophisticated methods to deceive you and, essentially, make you lose your money on this exchange. Everything has changed. Entire floors, entire offices, whole teams are working to ensure that you lose money. Otherwise, why do 97% lose money if everything supposedly works differently? No, everything works exactly the way I'm telling you. How can you use the MACD, the same basic, simple, and in fact one of the very first technical analysis indicators, to determine the current market context when everything has become tens of thousands of times more complicated? Let's look at 3 examples where the MACD gave incorrect entry points and figure out what to do about it. We can see that there is in fact a reaction, but then an impulse begins and quickly fades, and it doesn't let you profit from the upward movement at all, even though seemingly there is a bullish divergence. This is a specific first case of how counter-trend trades play out. At the same time, as a rule, the MACD with standard settings shows trend-following trades much less frequently. As for entering counter-trend moves to catch the peak, notice that there is a divergence for a long time. But during the upward impulse here, And again, during the next upward impulse, stop losses are triggered, those that you most likely set just above the highs of these candles. Accordingly, until all the stop losses are taken out, the market will not move into a counter-trend direction. However, the divergence appeared much earlier, and you would have already hit 5 or even 6 stop losses trying to reverse this trend and essentially enter a perfect counter-trend trade right at the very top. Although it might look like everything worked out perfectly in hindsight, in reality that's absolutely not the case. You would have hit at least 5 or 6 stop losses and lost your money 6 times. And the third point is that divergence starts to appear and signal much earlier than it actually should, because at that moment it's simply not relevant. Let's take a look together. Here's the weekly chart where you can see divergence in many altcoins here, 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 and here. It's huge. It's accumulating. It's been building up on the chart for a long period of time, a lot of it for a year and a half, even 2 years. However, the market isn't showing any growth. At the same time, this is a counter-trend trade in the accumulation zone on the weekly chart, aimed at potential risks for a particular altcoin that we see now on the chart. But there's no follow-through, no sign of growth, although eventually growth does happen, as we've seen with coins like Compound or Bitcoin Cash. However, the MACD indicator showed divergence much earlier than it actually needed to. Accordingly, you would have bought your positions much earlier than was actually relevant, and you would have ended up with a poor entry point, a completely unfavorable risk-to-money management ratio, even though in hindsight, everything seems to look perfect. Now let's take a look at our indicator. The histogram is based on a huge number of different moving averages, and it's not just MACD, but also EVS, the M oscillator, Bollinger Bands, and others, about 10 indicators in total. It shows perfect divergences, literally cent for cent. So we can actually compare two charts here. On one side, we have the standard MACD, and on the other, our proprietary indicator. And as we can see, according to our histograms, the indicator is called PO11 histogram. Our own divergence development is much cleaner, much more interesting, and much more accurate. In this case, we perfectly identified the upward movement and the market reversal. And here, we perfectly identified the downward movement and the market reversal right at the very peak. With all that in mind, let's look at an Ethereum case where our indicator showed a fantastic divergence. The histogram is falling while the price itself is rising, and Ethereum dropped by 50% on the daily chart. Just imagine what you can do on the 1 minute and 5 minute charts. Setups are appearing literally as we record this. Everything you need to start working with this indicator. Get it via the link in the description. After that, open it on TradingView. There you see it's open. And that's basically it. The indicator is ready to use. Let's take a look together at how it works in combination with our green-red line, the one we discussed in the previous video. The red zone, the distribution zone, the area where you need to exit your position, the area where the market always reverses on the daily chart according to how market makers use this indicator. And what do we actually see taken together? The red line plus the divergence on our histogram, which unlike the standard MACD, indicated the most precise, perfect entry point you could imagine. You couldn't come up with a better one. In fact, starting from that very doji candle we saw on the chart, right from that moment, Ethereum dropped by 50%, 48%. And at the same time, the recent upward movement also formed with a divergence just recently. Ethereum was priced at $1,800, and after that, it reached $4,000, something truly remarkable. But how was one supposed to know that it was necessary to enter a trade at $1,800, that it was the right time to invest your money? There was a divergence on the histogram, but this time in the opposite direction on the PO histogram. And after that, the green zone, which as a whole indicated the accumulation zone, the period when market makers, unlike in the red zone, are not selling, but on the contrary, are buying up their positions. You accumulate together with the market makers and then get an explosive growth of up to 300% returns. This indicator is good because it is used by market maker hedge funds, and it has never been wrong. Let's even take a look at the weekly chart. The green line for Bitcoin. This is the bottom in 2020. This is the bottom in 2018. This is the bottom in 2022. It's always the most precise bottom for Bitcoin on the weekly chart. Take the absolute lowest point of the cycle. At the same time, consider everything together. Sometimes there is a divergence, sometimes there isn't. However, in the moment of 2022, there was a divergence, and it was very clear. The PPO histogram is our proprietary indicator. In fact, after that, it confirmed for us a potential entry point for a long at the bottom, at the very bottom, at the absolute bottom of the entire cycle. It's absolutely incredible. I'll leave a link to the indicator in the description of this video. Be sure to check it out. Understand one simple thing. one simple but at the same time absolutely unique thing, and it is as follows. You can't use standard indicators at the current moment in time when the market is overflowing with absolutely greedy market makers, when the statistics show that 97% one way or another lose their money in this market and only 3% make a profit. You need to have something unique to earn money, and definitely not standard approaches like MACD or other standard indicators like RSI, Bollinger Bands, which have been used for a very, very long time. And only back then, 100 years ago, did they show us the right entries and exits for trades. Now everything has changed and works completely differently. If you found this video helpful, be sure to give it a like. It really helps the channel grow and motivates me to create more content for you. So this was Alex with you. See you soon on the ViceFlow channel.